Hello, everybody, and welcome. As we like to do every week, we like to take a look at the past week's market activity and then kind of bounce around the market and look for something to trade. Well, if you've been watching the markets at all for the last few weeks, I don't think it's any surprise. Obviously, the markets have been tanking and volatility has been increasing. And we're volatility-based traders, so actually, we don't mind this. We actually look forward to this kind of volatility. It helps our trading. We prefer the high volatility kind of trades for the most part. And they all look about the same. This is the SPY, this is the NASDAQ, and this is the Russell. So since we're such fans of volatility, I'm going to show you how to actually trade volatility itself. Now, volatility is a pretty tricky thing to trade, so I wouldn't recommend this too often. But in situations like this, when the volatility is really kind of on the rise, this is a good time to potentially take advantage of it. So you've heard of the VIX. That is the volatility index. And you can see this has been shooting up, obviously, as the market collapses, volatility increases. But you can't trade the VIX really itself. It's not really a tradable product. So what I like to trade is something called VXX, which is what they call an ETN. It's a similar kind of version of an ETF kind of vibe. But you can see it follows the VIX. It's been doing essentially the same thing. But this is a tradable kind of asset. So how do we trade volatility? Well, it's also different as well. The numbers involved are all different because volatility, for the most part, trades cheaply. What I mean by that is people know volatility is not going to last forever. So at some point, if you can make a bet, let's say 6 months from now, hey, volatility is going to come down over the next 6 months, like you've seen it happen over here until this most recent spike, you'd make that bet. But everybody in the world knows that, so they're not going to let you make that trade for very much money. They're not going to give you much money for that trade, and I'll show you what I mean by that in a second, because everybody knows the future. Everybody knows it's not going to be this volatile forever, and so they're not going to let you make trades that are like supposedly easy money. There's no such thing as easy money in the stock market. So let me show you what I mean by that. So here's what it looks like. So what we're going to do is we're going to bet, like everybody else, that maybe volatility won't last like this forever. Now, it may continue to go up for the next couple weeks or so, but we make our trades in around the 45-day window. So our bet's going to be that over the next 45 days, even if it shoots up, hopefully it'll come back down at some point. So if I go to a trade page, what we do is we always look to trade as close to 45 days as possible. So tomorrow this will be 46. And what we're going to do is we're going to just limit these because the strikes don't matter. It's going to be very small. Remember, we think that the price of this stock will go down over time. So we're going to sell a call spread. Okay, and the way we sell call spreads is we always start by going at least one strike above the stock price. Now, if this was a regular stock, you would see this be fairly expensive. So let me show you real quick what I mean. If I go to the SPY and do the exact same thing, we'll go to this 47-day window. It's at 357, so I'm going to go to 358 and sell a call spread. And you can see, if I do that, I'm going to collect 58 cents for $1 wide. Okay? But now, let's go over to volatility, and you'll see the huge difference. Same thing, we're going to go right here. We're going to sell one strike above at the 22 strike. And if I sell that vertical, look at that. I'm only going to collect maybe 26 cents. So less than half of the SPY. And that's what I mean by volatility trades cheap. Everybody knows volatility will eventually come down. So they're not going to pay you that much money to take this kind of trade. You're going to have to risk a lot more money to make a lot less because we all see the same picture. So what I do when I trade volatility is same thing. I start one strike above. You always got to start by selling a strike above. I always make these at least $2 wide, and I'm looking to collect 50 cents or more on a trade like this. So my minimum risk to reward is when I sell volatility in VXX up here, I always do at least a $2 wide call spread, and I always look to collect 50 cents or more on the trade. And if I can't, I don't make the trade. You can if you like, but again, again, this is $2 wide. So if I collect 48 cents, that means I'm risking $152 to make 48. So there's rules involved with everything. You can tweak them to however you like. This is how I do it. But our trade for tomorrow will be, we're going to make the assumption that hopefully VXX might spike a little more. and I'll sell this 22-24 call spread for 50 cents or more. And if I can't, then I won't make that trade. If the volatility drops tomorrow, if it goes up and I can't get my at least 50 cents per $2 width, I'm not going to make that trade. But that's how volatility works when you're trading it in the market. Obviously, you're going to have to risk a lot more to make a lot less because we all see the same playing field. But if you want to make that kind of trade, this is how you would make it in a volatility kind of asset class. Hello everybody, Cal here with an exciting new tool I think every trader should have. I have just spent the last year of my life writing this book, Learn to Trade in 7 Days. I believe this will be a resource you can use for the rest of your life. This is not time sensitive. This is all about trading from start to finish. This will never go out of date because trading is done a certain way if you do it the way I teach. And so if you have this book as a reference material book, this is going to last you for generations to come. So this book is broken down into 7 days. And essentially I start from ground zero to finish. I start with what is an option in the very beginning. Then I get into stocks versus options, basic option strategies. I get into how verticals work, how to use them. Then into Iron Condors. And finally I teach you how to make a trade and manage a trade. And I believe this book is such an important tool. If you go there now to this link below here, I'm selling this book for only $9.99. But I'm so intent on all my students getting this book because I really believe it's so important to have. It's such a useful reference tool that if you go to this link now, not only will you get the book, but I will give you for free any one of these courses here along with it. That's how important I believe this book is. So if you go there to buy the book, you will get any one of these 5 courses for free. And that is right here. And again, I really believe this is such an important resource that I'm essentially giving it away for free because the course alone, if you were to buy it, is going to be, who knows, but they're all valued at around $100 depending on where you buy them. So you're buying a book for $9.99 and getting a course for free valued at around $100. And all you need to do is go to this link here. And if you go to this link, you will see this screen pop up. And you'll see right here, only $9.99 and a free course as I've just shown you below. So go to this link today and jump on this deal because it will not last forever. Get my new ebook and a free course for only $9.99. I can't do much better than that. Hope to see you all there.